You were long oil, and you were right. Oil really did go up. But you didn't buy oil itself. You bought the fund that's supposed to move with it, the Big Oil Fund, USO. So every few days, you open your account to see how much you've made, and the number isn't going up. It's slowly sliding down. And you didn't do anything wrong. Your direction was right, your entry was fine, and there was never a crash day you could point to. You could pull up the oil chart and show, start to finish, that you were right the whole way. And your account just keeps getting smaller. So take these years as a whole, start to finish. Oil's price ended up about 47% higher, while the fund that's supposed to ride oil up ended down about 44%. You got the direction right, and it still cost you almost half your money. Today, I'm going to trace the exact path that money took on its way out, because once you can see that path, you can measure this invisible headwind before your next trade, with one line of math in your head, and decide whether it's even worth getting in. First, who this is actually aimed at. If you hold anything overnight, or you swing positions over days and weeks, or you're holding one of those funds that rolls itself, USO, UNG, the VXX family, then this headwind is aimed straight at your account. If you're purely intraday and you're always flat well before any roll happens, you can sit this one out. But the moment you leave a position on overnight, stay with me, because this one is yours. First, why the path is invisible. You go down your statement line by line looking for where the loss was charged, and you can't find it because there's no line on a statement called the roll. A futures contract, or a fund built on futures, has to move its position every so often, out of this month's contract and into next month's. The industry calls that rolling, and your statement never shows it as its own charge. But that's exactly where the money goes. So how does it actually go? Almost everyone gives you the same answer, and the answer is wrong. They'll tell you that rolling means you sell the cheaper contract you're holding and buy the more expensive one a month out, and that the little gap between the two is a cash fee you hand over every time you roll, like a toll. It sounds right, but it isn't, because both trades, the sell and the buy, happen at the fair market price in that moment, and nobody takes a cent out of your account. The roll itself costs you nothing. So the real question is still sitting there. Where did the money actually go? The answer is hidden in a strange habit of futures prices. Let me use round, made-up numbers so it's easy to keep in your head. The same barrel of oil sells for $50 right now, but the contract for delivery next month costs $51, and the month after that costs a little more again. Why does it get more expensive the further out you go? Because someone has to actually store that barrel until then. The warehouse costs money, the cash tied up in the barrel costs money, and all of that gets added into the price of the later months. That upward sloping curve has a name, contango, and it isn't just an oil thing, and it isn't something I'm making up. In a 2018 study, Irwin and his co-authors measured 19 commodity markets one by one, and on average, the curve alone dragged off about 3.3% a year, and in 13 of those 19 markets, even after you count the move in the spot price, the whole thing still finished in the red. But don't relax because of that 3.3%, because it's a blended average, pulled down by the calm markets, and even by the few whose curve leans the other way. And what you actually trade, oil, gas, volatility, sits at the steepest end of that curve. So what that number really shows isn't how small the drag is, it's how widespread it is. This curve is bleeding people all across the commodity markets. The name doesn't matter. What matters is what it does to your account. So do the math yourself with those same small numbers. You're holding the $50 front month contract. Next month's is trading at $51. And for this whole month, oil doesn't move at all. It just sits at $50. When your contract hits expiry, it has to converge to the spot price. So it drops back to $50, and that part is certain. But you don't want out, so you roll your position into that $51 contract. And when it gets near its own expiry, it has to climb back down to $50 as well. Look at what just happened. You rolled in at $51, it fell to $50, and on a barrel of oil that went absolutely nowhere, you lost $1 out of thin air. And $1 is 2% of your $50. Oil didn't move an inch, and you're down 2% in a month. That's the whole secret of where the money went. And if you remember one line from this video, make it this one. You're not losing because you got the direction wrong, You're losing because of what you're actually holding, and what you're actually holding is time. That's the headwind, a price you pay for being long time, not a penalty for being wrong on direction. Your call was right the whole way through, but every extra month you keep your grip on it, that curve bills you once at exactly this rate. 2% a month, run out over a year, is roughly 24%. Oil goes nowhere, and you still lose. And I'm guessing you're already telling yourself this isn't a big deal. 2% a month, 20-something% a year, that's about the same as a fund's management fee, right? It isn't, and that's the second mistake, and it's the more expensive one. A fund like USO charges about 0.76% a year, but the drag you just worked out runs 20-something% a year, which is roughly 30 times as much, so it really isn't the same kind of thing. And it's worse than a fee in one way. A fee you can always avoid, because if it's too high, you just move to a cheaper fund. But this one you can't, since as long as the curve stays this shape and you keep holding, you keep paying it, even when your direction is completely right. And think about what that does to you. Oil has to rise 20-something% just to get you back to break even, which is more than most traders make in a whole year. So you're deep in the red before you've made a single dollar.
And if you trade for a living, one trade at a time, this is the part that really hurts, because the edge you fight for on any single trade is usually under 1%. While this drag is certain, it comes out of you whether the trade won or lost. And every month it takes another slice of that thin margin. So while you're busy working your win rate out front, it's quietly taxing you from behind. And in one quarter, it can eat your whole edge. So how much of the long run does this one curve actually decide? Erb and Harvey, in a 2006 study, ranked commodity futures over more than 2 decades by who finished on top and who finished at the bottom. And fully 91% of that ranking was set by this rolling curve, not by whose spot price happened to rise harder. Now, to be fair, this is a long-run ranking over 20-plus years, so it doesn't predict tomorrow's move, and in the short run, your direction is still what decides whether you live or die. But hold a position for months or years, and the thing quietly deciding it in the background is this curve. You can picture this headwind as a down-escalator, and you're walking up it. Every step you take up is you being right on direction, but every step of the escalator itself is sliding down under you. That's the curve rolling, the ground beneath your feet pulling itself backward. If your climbing speed exactly matches the escalator's descent, you're stuck in one place. Every step is right, and you haven't gained an inch. And if the escalator runs even a little faster than you climb, you go backward while you're still walking up. Which is why, just give it more time, let the trade play out, is the single most expensive thing you can do on this escalator. The longer you stand there, the lower it carries you. But this picture has a flaw, and the flaw is the most interesting part of the whole thing. A real escalator runs at one constant speed, but this futures curve doesn't. Its slope changes, and it can even flip over completely. If one day the near contract is more expensive than the far one, and the curve slopes down instead of up, the escalator reverses and starts carrying you up. Now the roll stops charging you and starts paying you instead, and that downward shape has its own name, backwardation. But don't get excited and start thinking you found free money, because the market is paying you to carry a risk it doesn't want, and that payment has its own price. This whole video, I'm only ever standing you on the losing side of that curve. The side that pays you has its own costs, and it's out of scope for today. So here's the one line you can run before you ever put the trade on. Your yearly headwind is roughly the front month price minus the next month price divided by the front month price times 365 over the number of days between the two contracts' expiries. Drop our example in. 50 minus 51 over 50 times 365 over 30, and the answer is about negative 24% a year. When it comes out negative, that's your oil sits flat and you're still losing speed. And if you ever run it and it comes out positive, then good news, backwardation is paying you to hold. Both of those prices are free to look up, so this is one line of math in your head and an answer 10 seconds before you enter. And the sneakiest part of this whole headwind is that it never shows up as its own line on your statement. The less you can see it, the more calmly it keeps collecting. So the real name for it, for you, isn't the thing that blows up my day trades. It's a tax you've been paying the whole time without ever knowing you were paying it. Which brings us back to the question we opened with.
Oil up 47%, the fund down 44%. And now you know what the biggest single piece of that gap actually is. It's the shape of a curve you'd never once looked up. So next time, before you hold a long-term position tied to oil or gas or volatility, spend the 10 seconds and run that one line. And it'll tell you right there how much this headwind is going to take out of you in a year. But there's one thing all that math can't fix, even once you've worked it out and made your peace with it. I was right, and I still lost, is a hard thing to swallow. And that exact feeling, the sense that the money was quietly lifted out of your pocket, is the easiest fuel there is for your next revenge trade. You can do the math on the mechanism now, but the tilt the mechanism sets off needs something to pause you before you click. And that second half is the whole reason I built Meridian. It does the intraday loss caps and the P&L caps that every risk tool does. And then it does one thing no loss limit can. Before you actually click that order, it reads that you're heated, and it stops the order from going through. It's only one way to automate that. It isn't the only fix, and watching that feeling yourself, by hand, works just as well. If you want to see it, it's at meridianpsi.com. And if this video helped you finally see a loss that never made sense before, subscribe. That's how the next person who's right on direction and can't work out where the money is going gets to find it too. The two cards, top left and top right. One takes this curve a layer deeper, and the other is a different trap you've probably fallen into yourself. See you in the next one.